I'm David Worrell. You are with DIY CFO for our Finance Friday. And just in case you're wondering, in the background there is my FuseCFO banner. That's because Fuse is the company that I incorporated 10 years ago. We provide all kinds of accounting as an outsourced finance departments. We do accounting and finance and CFO services. And the DIY brand that you're familiar with is all about the CARES Act. It started with the pandemic and the CARES Act, and all about how you can learn more about finances to be your own CFO and learn more about the ERTC and the PPP and the EIDL in particular. So we've been doing these webinars for almost, this is the second anniversary of COVID, and we've just passed the 2-year mark. So we were doing them every Friday for a while, which is how they got the name Finance Friday. Now they're monthly. And if you registered to be on this call, which everyone here did, you will get the monthly reminders that you're welcome to join us. And our topics have now broadened from stimulus packages and PPP and ERTC to be much more broad. Without further ado, our main event, and welcome to Lori Hager, Esquire. I always like writing Esquire. Do you write Esquire on your own stationery? Is that a legal thing?
I do. And yes, it is. Absolutely.
Excellent. So that means
I
that
have
Lori,
to identify as an attorney.
That's right. So that means Lori is an attorney. Tell us just a little bit about where you're at in your practice area, what you specialize in.
Sure. So I am an attorney in New Jersey, the Garden State, for those of you who like a chuckle. I have been practicing since 2002. I clerked for a judge, and I specialize in small and medium-sized businesses. And what that means is I help you. I came from a small business. My parents own a small business. And I learned very quickly that there was not really good legal services that were helping small and medium-sized businesses. You're caught in the gray area where the big firms didn't want to talk to you, and the really small firms that did a lot of great work weren't focused on you. So I decided to fill that hole. And I do it in 2 ways. I work on your contracts. I help you enforce your contracts, and then I protect your intellectual property. So your trademarks, the names of your businesses, your copyrights, everything that you put on the internet. And if you get a patent, congratulations. I don't draft them, but I do enforce them. So I litigate them in court. So I am truly the small business attorney. I'm here for you. So that's what I do in a nutshell.
Thanks for the introduction. And yeah, that's exactly why we called you, Lori, to help us out on this really important topic today. You and I were having a conversation about what is the corporate veil, and the corporate veil to protect business owners from liability. And so you told me that as a corporate veil is supposed to let money flow through the business up to the owner, but to block the liability, right? You can see Kate Middleton, but you can't touch her. So the money flows through the veil, but not the liability. And tell us a little bit about the normal protection. If I've got an LLC, and I'm a subchapter S registered LLC, what kind of liability do I just kind of automatically have from that?
Sure. Well, in my world, there are 2 types of LLCs. There are 2 types of every kind of company. And what I mean by that is you have a normal company, and then you have a professional services company.
And we don't have a lot of professionals on this call, and they're going to know what you mean, right? A professional services is an accountant or an attorney or a doctor, and they understand they have much broader liability. So let's focus just on the non-professional LLC.
Sure. So essentially what the veil means is that as long as what you do is not fraudulent, significantly gross negligent, or intentional, then the company itself will take on the liability, and it will shield the owner, even if you are the only person in the business, like myself. So I have a law firm. I like to call it a practice because I'm the only attorney. So even though I am clearly the one who is the actor, who is doing things, if I wasn't an attorney, I would be protected as long, again, as it's not fraudulent, it's not intentional, or a gross negligence. So that's the benefit of having the veil and the benefit of having a company. And of course, it also protects you from financial liabilities, meaning that the IRS, okay, when it comes after you for tax issues, it's coming after the company as long as you maintain what the corporate requirements are with regards to the company. If you don't, then the veil's gone. And it's you standing out there in whatever you're wearing that day and hoping for the best. So we're going to get into that later, I believe.
Yeah, and that's what they call piercing the veil, right? Piercing
That's right.
The veil. So the person who's suing you has poked a hole all the way through the liability shield of your company. All right, good.
Mhm.
That's the topic for today. And the key concept here of that we're going to go through in depth is how to make sure that the company is not your personal piggy bank. And this is really something I'm passionate about, because I hear business owners say this all the time. Well, my personal bank account didn't have any money in it, but I had my company credit card with me, or I have a company ATM card. So whenever I need cash for lunch or whatever, I use that. And they really blend their identities, right? They are the company. They say, I started this business, I own this business, it's my whole life. I am the company and the company is me. But that's really counterproductive attitude, isn't it?
Oh, it's worse than that. I mean, that attitude essentially removes the corporate veil, and anybody, meaning any individual, any employee who has an issue with the business, can come directly at the owner, and that means they get right into the owner's personal bank account and
Yeah.
personal assets.
So,
Because if the owner himself isn't keeping the separation, why should anybody else?
right. And so that separation is both the identities. You have a legal corporation, an LLC or an Inc. or whatever. The accounting, meaning the funds, the actual checking account is separate. And then there's this third concept of adequately capitalizing the company. Can you just say a couple words about that?
Sure. So, and it's interesting because many people don't know about this. When I
Oh, it's
start
new to me
businesses,
too. Yeah.
when I create them, and I'm speaking to the owner, whether it's a shareholder or the member, my first question is, when I'm drafting the operating agreement, is how much are you capitalizing the company? How much money are you putting into the business? And the response sometimes is, well, no money. The business hasn't made any money, so there's no money. Well, it doesn't work that way. The owner of the company has to buy their ownership, invest in the company to essentially buy their own ownership of the business. Now, that investment has to be, something reasonable. So, for example, if you have high overhead, your investment can't be $250. You're going to be looking at, 10,000, 20,000, and up $1 million. If you have a small business with very little overhead, it may be that your investment is only $5,000, and it's an investment. It's not a loan. You're not getting that money back. And that has to be very clear, because when you speak to somebody like David or your accountant, the accounting structure of the business is based on the amount of money you capitalize with originally, or the additional monies that you put in to continue capitalizing the business.
Yeah, that equity line, or at least the amount of cash in the bank, and all these things that add up to talk about what is the capital of the business is important, right? There's got to be enough there to say that the business is a separate entity and it can run by itself. So it's all part of the same key concept. The business has enough capital to sustain itself and run as an independent entity. That's the core concept there, right?
That's right. That's correct.
All right, great. All right, so let's talk about the fun stuff. This is great. We get to tell all kinds of stories about the foolish things that entrepreneurs do, and I'm probably guilty of half of these things at one time or another in my life. I like to think I'm a little older and wiser now, but boy, I hear entrepreneurs talk about, especially these first five, are just so common, right? I went shopping with a company credit card. I bought a Gucci bag. I went on a business trip with my wife and my family to Las Vegas, and we went to the casino and we gambled and we went to all the shows. And 3 weeks later, we came home and I put it all on the company credit card, and that's, I marked it down as business travel. Let's just start with just those two, especially the business trip. What's wrong? What's wrong with that?
So every expense that the business makes has to be on behalf of the business, for the benefit of the business. So if you're legitimately going to Las Vegas for a trade show, and you spend one day at that trade show, everything that you do at that trade show is a legitimate business expense because it benefits the business. The moment you step foot in the casino, and it's not because you're just going to the elevator, I see you, it's no longer a business expense. It really isn't. Unless, maybe you're a professional poker player, and there are very interesting rules for that, but it's not you. So no, and you have to be very, very careful, especially mixing up the credit cards. I'm sorry?
Yeah, and if your wife and children are at the buffet down the hall, business expense or not?
No,
No.
not a business. Well, unless they're your employees, then that's something different. And the answer is maybe.
Okay.
But again, the IRS isn't stupid. They're pretty smart, even though they act otherwise.
Yeah.
And they're going to learn. I mean, it has to be reasonable. It has to be an expense that is normal in your type of business. So if you are a landscaping company and your work is only in one state, let's say Massachusetts, and there's no reason for you to be going out of state, and there are charges with you all over the place and had nothing to do with vendors or anything like that, it's not easy to determine that it is not associated with the business.
Yeah. So you've mentioned the IRS here, but and that is a huge concern and something that we talk about all the time, the reasonableness of expenses when you get audited by if and when you get audited by the IRS. But as an attorney, you're also talking about the reasonableness in kind of a court of law situation where somebody's trying to, again, pierce that corporate veil, right? So does the IRS actually weigh in on a litigation matter, or is the standard the same? How do the standards differ if they do?
Okay. So you're correct. The reasonableness standard is for the IRS. For court of law, piercing the corporate veil is a separate cause of action, a separate complaint, and it allows the other side to access the financial statements of the company, which they would normally have access to. And once, if I'm piercing the corporate veil, I get access to those statements. I'm looking for certain things. I'm looking for, plane tickets for a company that people shouldn't be flying on. Yeah. I'm looking for shopping sprees that are relatively expensive and not simply to Staples or Amazon.
And if once you find that, if you find that, what is the standard that the judge or jury is going to kind of weigh against whether it was legitimate or not?
So in a civil case, as an attorney who's piercing the corporate veil, I have to show by the preponderance of the evidence that it's not reasonable.
So this word reasonable is kind of the same in between a litigation and IRS audit.
And remember, the people who are deciding reasonable with the IRS are highly educated financial people. The people who are deciding reasonable when it comes to civil cases is either a judge or a jury of your peers. Right. And peers is very loosely defined, so be careful with that word.
Yeah, I think that's our final slide. It says, remember, these people, the juries are humans, right? They get to decide any way they want, and what it looks like you're doing is really more important than what you actually did.
It is, and it's how you explain and how you describe what these fees were for and what you paid them for, and again, always attaching them back to the business. And these are external finances. We haven't even talked about the internal finances yet.
Okay, let's come back to these foolish moves real quick. Barter and self-dealing. You described the story of a contractor, since Dave was a contractor on the call earlier. Can you tell that story real quickly?
Sure. So when you have a contractor who who's doing a lot of great work, and are we talking about bartering?
Yeah, the barter and self-dealing, right?
Sure. So bartering becomes very difficult in business. So you have a contractor who is a mason, and it usually, I do apologize for those masons out there. It happens a lot with masons because their work is very expensive. And you have, let's say, an IT person. And so the mason is using the IT person for their IT work. And he says, don't worry, I'll just come to your house and I'll put up a retention wall, or I'll help you with your, something else. The difficulty there is, although the IT person's business is providing the service to the mason, the IT person's business is not getting the benefit of the mason's service. The owner's house is. And so that's not a true barter. Okay.
Right. And that works the same way. If the mason sends his crew to his own house, the mason's own house, to build a new patio, that kind of self-dealing doesn't benefit the business, right?
That's right. Even though the business is paying for those employees' time, and the business better be paying for those employees' times.
Yeah. That's right.
Or else you'd be in a whole other world of trouble. Another issue comes up when we're talking about employees is having employees who work for free. Family members shouldn't be working for a business for free, including spouses. And that's a problem. That's a form of self-dealing where the company should have been paying this individual. The money shouldn't have resided in the company's coffers, but it still does. And so you need to be very careful about that.
Yeah, I was surprised by these last four, the 6 through 10 here, that if you are actually, so if you're not taking a salary or not paying family members who are working, I can imagine paying somebody who's not really on the payroll is dubious, but not paying someone who is on the payroll, including yourself, is also a form of commingling funds. I think that's going to come as a big surprise to some of our folks.
It absolutely is. And for an example, an easier example is with an attorney, okay? Just because you can see it very quickly. So I have an attorney trust account, and my client's money goes into that attorney trust account, including their retainers. When I bill my client, I'm supposed to take the money out of my trust account, put it in my operating account, because now I've earned the money.
Right.
But if I leave it there, now my earned money is commingled with my client's money, and it's illegal. It's just as illegal as if I stole their money, because they, at some point, you can't tell what's mine and what's theirs.
There you go.
And
So
it's the same thing in your business.
Comes back to commingling. Same with buying goods with your personal credit card. You know, lots of our folks on the line today, I'm sure, are early stage startups and first and second year companies. And there's not a, maybe they don't even have a company credit card, but they go to Staples to buy printer ink and they whip out their personal credit card. And that's how they've been funding the company. They get the company off the ground by spending personal money. And that's actually also a form of commingling. How do you avoid that?
And again, this is near and dear to my heart. When I started my firm, I actually set aside, and of course I couldn't get a credit card because the firm was literally 4 seconds old. I set aside a personal credit card that I would only use for business expenses. Why? Because I'm anal retentive that way. And it was just easier to know that everything on this invoice from the credit card company was for the business. And then I simply wrote one check from the company to me to pay for the credit card. And I'll be very clear. The check went from Kyberia, which is my law firm, to Lori Hager. The check did not go from Kyberia to the credit card company. And that's important because Kyberia isn't beholden to the credit card company. They're beholden to Lori Hager.
Yeah.
And making that distinction is important.
Right. Okay. And the last one, number 10, I thought was the most surprising. You told me not to use my cell phone to text or WhatsApp so much. What's that about?
Yes. Yes. So the reason why is because when you have your cell phone and you're texting, if you actually look at your cell phones right now, if I were to use that text message string in court, I would have to prove to the judge the day, the date, the time, and the to and from with regard to that text message. And even if you try taking screenshots right now on a whole string, do it, try it, prove me wrong, it's almost impossible to get all that information related to each individual text. And that becomes very difficult if you're talking to employees who are telling you when they're coming in or when they're leaving, because I guarantee you're not going to need that information today. You're going to need it probably like 5 or 6 months when all that information is even more difficult to get a hold of.
Yeah.
Now, you're going to say to me, but Lori, I could just call Verizon and they'll give it to me. And the answer is they probably won't, not without a court order. In addition, some of these apps are not American-based apps. So Slack is very difficult to get any information out of. And then you go into other Asian apps such as WeChat or Kakao Talk, and those apps actually erase the conversations. So if you're a company that's dealing with manufacturers in Asia, and the manufacturers really enjoy using these apps, isn't that interesting? It's very difficult to get that conversation back and allow me to prove what happened during the conversation.
All right. Well, those are 10 good examples. I hope that that everyone's read through them and maybe sees yourself in a couple of those things, whether you're not taking a salary or you're paying a family worker or loaning money to family. I think all of these things are great examples of how to intermingle or commingle your funds. And if you find yourself doing even one of these things, guess what? You just punted your liability shield, right? Not a place where you want to be. So if you've punted your liability shield and then something happens, like somebody discovers fraud, or you go bankrupt, or one of your trucks runs over someone, one of your employees claims sexual harassment or illegal firing, or a fun one is a partner dies, and then you find out that that partner has been doing all kinds of crazy stuff behind the scenes. You are set to lose because you just punted your liability shield. You are set to lose not only all your business assets, but all your personal assets. And then, Lori, this is a term you're going to have to explain to us. You called it marital assets. What does that mean?
Marital assets, sure. So for those of us who are married and keep joint bank accounts with our spouses, and if your business that you may or may not own, well, let's pretend for this example that you do not own with your spouse, okay? If your business gets sued and it's not capitalized and you've lost the corporate veil, those individuals who are suing you can go after your marital bank account. because your assets are in there with your spouses.
So I've commingled my money with my business, which makes it all the same. And then I've commingled my money with my spouse, which makes that all the same.
All the same. And
now
guess what?
Yeah, even though Tracy has a car and a house at the lake all in her name, they can just go right past through me and pass through our commingled bank account, and even then
no, not in that. So in that example, let's be very clear. If your wife has property in her name, then no, they can't attack that. It's only the property that's in both of your names, because they're attacking your half of the assets.
Right.
And the question is what is your half? It doesn't mean it's 50%.
Yeah. Interesting. So ideally, I mean, if you were really obsessive about this and you were in a high risk industry, a high risk business of some kind, you could put all of your personal assets in your wife's name, or maybe in a trust or something like that. And then what if Tracy owns all of our house and cars, and she has a transfer on death to David? If Tracy dies and it's inherited by David, that's not the same as co-owning it, right? So that's okay.
That's right. That's right.
All right.
That's right.
Very cool. All right, guys. So how do you avoid the worst? We've described the worst for you of you use your text messaging, you use your text messaging app to talk about an employee who sues you, and suddenly you're finding that your corporate veil is pierced and you're giving up your home and car. How can you rewind and do the right thing? And that starts with what we'll just call the basic liability shield. So we already talked about this, right? You're going to incorporate. You're not just an individual. You're going to form an LLC or a corporation or a partnership of some kind. And then, as you said, Lori, you say we, not me. What's that mean to you?
So what it means to me is that however you put yourself out to the public will believe you. So if you put yourself out to the public as the entity, the business and myself are the same thing, I will come and do the estimate. I will come and do the work. I always look at everything. I am the owner. I do everything. That's a problem, because instead of it being Kyberia, my law firm, that's taking care of the work, it's Lori Hager. And there's no shield. There's no separation between what Lori Hager is doing versus what Kyberia, the law firm, is doing. So instead of making that mistake, you say we, right. Lori Hager and Kyberia will be doing this. Right. I'll send my team. We're going to look at that. I keep eyes on everything my team does. Right. So that you're making it very clear to the person who you're talking to that it's not you personally doing the work. You have other people, you have a company, you have a business. Even if you don't have other people, you have a business that's doing the work. You're taking off your human hat and you're putting on your business hat. Right. And that's who's doing the work.
And maybe even more than your business hat, your employee hat as an employee of the business, right?
That's right.
So we talked a little bit before about defining my role in the business as whether I'm the CEO or I'm the janitor, that I own the business, but I still have a role there. And my business card should even say janitor or whatever maybe it is to define my role. And likewise with employees, is it possible to elevate in your speech or in your correspondence or your proposals? Is it possible to elevate an employee to a point where they would then be somehow liable or mess this whole corporate shield up?
Yes, and that's a really good point, David. So if you have a favorite employee, somebody who you really, really like, and you call them, well, they're my partner. He's my partner in this deal. He's my partner. Well, the legal world defines partner as an owner, an ownership interest, meaning that what that employee says binds the company. And if you don't necessarily agree with what that employee says and you don't want the company bound, it may be too late. Because the rule again is the public will believe what they're told. So if they're told by the employee that the employee is an owner, then guess what? They are eligible to believe that. So you need to control your employees by making sure that they understand what their positions are. They are not owners. Okay, they don't have the right, unless they do have the right, to bind the company. And you must be very clear with them about that. Just because they're very good employees doesn't mean they're owners. And the other concern too is promising ownership. Maybe at the end of the year, we'll talk about you becoming an owner. But for right now, keep doing the good work that you're doing. And then the next thing you hear is, well, I'm going to be an owner. Well, I'm, at the end of the year, I'm going to be an owner. And January of the next year comes and all of a sudden they start talking about being an owner. Well, none of that ever happened. And all of a sudden the owner's like, no, wait, we never, well, but you said I'm going to be an owner at the end of the year. Now the end of the year's passed and now I am. And the reality of that is very different. So
Yeah.
you need to be very clear and definite with what the roles of your employees are.
Yeah, and I would think that that would certainly protect them as well, right? You don't want them getting into legal trouble by misrepresenting their own role within the company. So,
Yeah.
good. Finally, corporate formalities. We've got a slide all about that. So enough to say corporate formalities means the documentation, the legal side, the board minutes, and that sort of thing that we're going to talk about. So let's look at each one of these things a little more carefully. I guess maybe we already went over this, but we talked about treat yourself like an employee. What about advances and expenses? You know, if I'm an employee, I certainly don't go to my boss and say, hey, I need an extra $10,000 this week for my kids' braces, or you know, can you give me $20,000 without any explanation? How do you treat that short-term cash need on the personal side, or the fact that you went out and bought 3 new laptops on your personal credit card? How do you treat that and keep it correct?
So the most important thing is documenting it. So to keep going with your example, let's say John Smith did come to you as an employee and said, listen, you know, I really need an advance on my salary. I need an advance. It's not a gift, it's an advance. And so the first thing you would do is you take out your pen and you'd say, yes, sure. You take out your pen and paper, you'd write down John Smith requested an advance in this amount. And then in John Smith's later paycheck, you'll come to an agreement. So in order to pay back the company for that advance, that loan, I'm going to take $150 out of your paycheck. And all that needs to be written down so that, and sent to John Smith. So John Smith realizes that we're not going to play games with salaries, you know, because of course, in all of this, you're talking about taxes and all these other fun things. As an owner of the company, you should be doing the same thing. If you truly need an advance for personal reasons, which is a loan from the business, you are putting together a document, and depending on the amount, it would be a true loan document with a promissory note and everything else that puts into effect that you are taking a loan and that you are becoming a debtor to the business.
Right.
Okay.
And vice versa, right? If you've got the expenses, and by the way, we have one relevant question here from Caroline, who says, if one of my employees is out in the fields and needs to purchase some items for business and he uses his own credit card, can't I just have that employee turn in receipts and reimburse them?
Absolutely. And you can do that for yourself as well. The
Right.
difficulty becomes when that doesn't happen, when you are doing it for yourself as the owner and you forget and you don't bring the receipts and you don't do the accounting because there's nobody over you forcing you. So if you had an employee who went on their own and put gas in their car for doing errands for the business, okay, and they just came to you and said, listen, I need $25 for the gas to put in my car. Well, it may be very convenient for you to reach into petty cash and hand them $25, but the reality is that you shouldn't. You should request a copy of the receipt because you're going to claim that as an expense on your taxes as well, and you're going to need the receipt. And then you pay them preferably with a check for the $25. So there's proof of everything going both ways. And you would do that for yourself as well.
Yeah, it's interesting, even with other vendors who claim reimbursement for expenses, the loss, as I understand, I'm not a lawyer, the rule that we use in accounting, let me say, is the person who holds the receipt is the one who claims the expense. For the other person, it's just a wash through. There's no expense and there's no income. It's just I did you the favor of actually buying this. We don't even have to talk about it anymore. But you can't, you know, your employee or your vendor can't go back and put that receipt on his taxes as a deduction from his income because he passed it through to you and got reimbursed. So the person who holds the receipt is the key.
That's right.
And on the same thing, on the other way around, on taking salaries and putting money into the business, Fred asked, can you continue to fund the business on a monthly basis versus a lump sum in the beginning?
Yes, you can. But there needs to be something in the beginning. There needs the first funding. Let's say it's $1,000. That's going to be your initial capital. And then every month after that, you're going to be continuing to do a capital infusion into the business. And you just want to keep track of it. And again, we're talking about capital infusions, not loans. So you're not expecting to get that money back. Okay, that is money.
But there certainly are times when an owner could loan money to the business, aren't there? And as
Oh,
long as that's,
absolutely.
yeah, and as long as
Yes.
that's documented as a loan, you're okay.
Yes. And in fact, there are reasons that you would want to
Right.
loan the business money. If you have a business partner and you are the money person and you've already put in your capital infusion and now the business needs more money. And so you want the loan, you want to give the business a loan and get the money back. It's also important as well to document it because if God forbid something happened to that business, it goes into bankruptcy, you are a creditor of the business like all other creditors. However, there's no documentation, you're not a creditor. It was
That's
either a capital infusion or a gift.
interesting. All right. Last thing to talk about just briefly one more time is if you are not taking a salary, how do you treat that?
Okay, so I like to say that the owners of the company get paid last. So if the business has enough money to pay all of its monthly or however you pay them expenses, and there's money at the end, and the owner doesn't take a salary, okay, there are two ways to handle that money. It could be a capital infusion, or it could simply be the owner's not taking a salary. And that money for the owner is lost, okay? And then if at a later date, all of a sudden the owner says, no, wait a minute, I need a salary. And now all of a sudden I'm going to try to back pay myself. It becomes very difficult and it becomes commingling, okay? Because now you are admitting that you had left money in the business and you want it back. And there's no documentation to show it. A much better way of doing it is that you say, okay, I anticipate wanting to pay myself a monthly or weekly salary, you know, of $2,000 a month. Okay, and 1 month rolls around and you can't pay yourself. Okay, so that becomes a loan. You've loaned the business $2,000 and you write it down. Then money
And you
becomes a
record
loan.
it, yeah, write it down, not just on a piece of paper, but you record it in your accounting records as an accrued salary to David, who was still owed, but not taken, right?
Correct.
Yeah.
And then that salary can be paid back. And it's clearly, you know, earmarked as a salary to be paid
Right.
back.
Yeah, it'll appear on your balance sheet as a liability to David as a unpaid or accrued salary expense. And most of our clients are actually doing that. You know, so many young companies don't pay their owners on a regular basis, and I totally get that. But I beg them, please just allow us to put the accrual in there. And you know, not only does it protect you legally, but from an accounting point of view, it's so important to realize the value that you're contributing to the business. So on a P&L, you know, these same people who don't take a salary are very proud to show me their P&L that they made $1,000 last month. And I say, yeah, great. That looks like you made $1,000, but what was your time worth? Maybe $4,000 or $5,000 or $6,000. So if you've put your salary into the P&L expenses, suddenly you see you're not making a profit. You're losing $4,000 a month. So accruing the owner's salary, so critical, important, both legally and from an accounting point of view. And as I said at the bottom there, 10 out of 10 accountants and lawyers agree.
So there's an interesting question, David, that was in the chat, and I just want to address it really quickly, if you wouldn't
Sure.
mind.
Yeah.
It says, what about taking money as a dividend? So I just want to clear up some language here, okay? So
Okay.
when you have an LLC and the owner takes we'll call it loosely a salary, they're taking a distribution, okay? There's no such thing as salaries for owners in an LLC, it's a distribution. And you want to make it a regular distribution. When you have a corporation, that's when the owner would be taking a salary, just like any other employee. And to the extent they take any profits out of the business, it would be called a dividend. And much like any company that is traded on the stock exchange, you are paid dividends at a regular interval, whatever you decide they are. And if the company decides, well, I'm supposed to pay fourth quarter dividends, I don't have enough money, there's a notation to that. No dividends are paid, we made that decision. Come, you know, the next quarter, if there's enough money to pay dividends, there's a notation that we've paid dividends.
Yeah.
So it's not as easy as just taking money out of the business, writing yourself a check and saying, oh, we're going to call it a dividend later. That will drive David and his team crazy. Rather, you want to make sure it is documented.
Yeah. So two quick things. We see that all the time. People take money out and we have to book it as a dividend, but it's still not technically correct, right? I mean, it's technically it is I call it a distribution. You call it a dividend, is whatever. It's cash out of the business to the owner, but because it's not a regular, predetermined and authorized sort of distribution, it's legally still going to get you in hot water. Accounting wise, I've done it correctly by taking that you got a haircut and put it on your corporate credit card, I'm going to take that and call it a distribution, but that's not the right way to do it. Secondly, you said that owners of an LLC are not allowed to take wages. And I know what you mean, but I'll tell you what, I'm an owner of an LLC and I take a payroll every month. And so I want to be very clear with people. If you are a subchapter S, you are absolutely allowed to have a W-2 wage. And that's one of the benefits of a subchapter S corporation. If you are a sole proprietor, the only single member of your LLC, or a partner in a true partnership, then wages are problematic, and you need to talk to me about things called guaranteed payments and distributions and all kinds of other things. But
That's right.
We'll avoid that for now. I just wanted to be sure that I don't get a bunch of questions about, wait a minute, I can't get paid. So you are certainly allowed to take payroll if you are a subchapter S corporation, or a C corporation for that matter. Okay. Next is, what do we mean by corporate formalities? We said corporate formalities are one of the ways to stay out of jail. And the first thing, I'll take the first one, you can have the second block. The first thing is the accounting formalities. You must have clean, accurate, and timely books. That means that your balance sheet balances, that it reconciles against the bank, that you're looking at things like loans and you're truing them up for interest expense. And at the end of the day, you know that the documents, your P&L and your balance sheet are actually true and accurate, and you're keeping them up. Keep receipts. We already talked about that. We love the new QuickBooks phone app that allows you to take a picture of the receipt and attach it right to the transaction. Lots of little apps will do that for you now. Document the use of your personal funds. If you do go to the office store and buy that computer with your personal credit card, submit an expense report and make sure you pay yourself back. Never use ATM cards or cash. Drives your accountant crazy, and it will open doors to all kinds of questions from Lori's side. So if your bank gave you an ATM card, I recommend destroying it. If you are in a cash business, I recommend getting a big old paper checkbook and going back to writing checks to people who are, casual labor or whatever that might be, where you used to maybe just pull a $100 bill out of your pocket. And finally, paper checks can be your friend, particularly for distributions. When you're paying yourself, make sure you've got a nice paper trail. So I keep coming back to paper trail for accounting, and that's so important. Paper checks or ACH, but not a direct bank transfer. If you're able to log into Bank of America and drag and drop money between the business account and your personal account, probably a bad idea. I intentionally opened my corporate account at a completely different bank, and I do not connect them for wires or anything else. I write paper checks, or I take a distribution on my payroll check. There's a way in QuickBooks you can say, what's my salary, and then what are the other payments, and one of those can be an owner's distribution. So that works fine too. All right, take us down to the other last 5 on governance there, Lori.
Yes. So of course, we're being consistent. Once we make a rule for our business and our employees, we follow it as owners, which means if everybody's getting paid once a month or once a week, we are doing the same for ourselves, putting the company first. And what that means is that the owner gets paid last. Everybody gets paid before the owner. And once you have those liabilities paid, then you are free to take money out of the company. And I'll be very clear. It doesn't mean you're paying off, entire loans, but you are making the payment for the loan that month or that quarter, or however you've decided that you're going to pay yourself. Documenting the reasons for your decisions and your transactions. Those are simply board meeting minutes. And even if you're the sole owner of an LLC, you should be sitting down with me, myself, and I, and coming up with a plan for that year and following it. And to the extent you deviate, that's okay, but just make a note of it. And that really helps me as your lawyer, should something, God forbid, happen, to show that you really kept your personal and your corporate selves separated. Read your organizational docs. Have organizational docs first, and then read them. And that's really important, especially if you're in a partnership. Your organizational docs are not only going to tell your partner what needs to be done, but they're going to tell your partner's heirs what can be done and what's allowed and what's not allowed. It's really the rules of the road for your business, and you should have them. Banks require them if they're going to give out loans. I believe, and correct me if I'm wrong, David, some of the COVID loans required to see in some instances.
Once in a while, that's right. So just to be clear, corporate documentation means your articles of organization, your shareholder agreement, your bylaws, your partnership agreement, whatever might apply to your particular organization. But you know what? There's actually, maybe to make this even more confusing, lots of small companies incorporate online. They go to the Secretary of State, they get a new LLC, and that's what they've got. They've got one page that says, by the laws of the state of North Carolina, I am an LLC, stamped by the Secretary of State. Now they don't have any corporate documents. Where do they look to find out what is required of them in terms of record keeping?
So every state is different. Every industry is different, but at a minimum, I'd want to see an operating agreement or a shareholders agreement, bylaws. And you may want to grab yourself a corporate attorney and have them go over it with you. Typically, there are literally corporate books, or 3-ring binders back in the day. And back in the day, you'd have a corporate seal, super fun. But you would want to have something similar to that, whether it is in paper form or it is on your computer. I mean, in there, they actually have membership certificates, you know, like you would imagine stock certificates would have looked like back in the day, and they have them too. Again, super fun, but it's a reminder, more importantly, that you're keeping track of the membership interests in your LLC or the stock shares in your company. So if you did give them to an employee, 10 years rolls around and that employee quits and they walk away, they walked away with a portion of your company that you didn't get back. And it's not just magic, like you need to make sure you get that back. And that means buying the individual out in some instances. So you need to track that and be very careful, because I guarantee if somebody else found out about it and they can get money out of you, they will.
All right, sorry, we're just running out of time. So let me go on to the last big topic of how to protect, best practices to protect yourself from the worst case scenario. Insurance. I love your phrase. Insurance is a safety net, not a hammock. Tell us about the different kinds of insurance that I might want to look into as a small business owner.
Okay, so I'm not an insurance broker. I don't pretend to be one on TV. However, when I speak with my clients, I want to make sure that they have the correct insurance for their business. So for example, as an attorney, I don't generally get general liability insurance because I don't have a building, but I do have malpractice insurance. As a non-professional, you want to get your general liability policy. You want to get your errors and omissions for professional liability, and you want to get directors and officers, depending on what applies to your business. Then we get fancy. Okay, and here we go. We're putting on our ball gowns and getting ready. Key man insurance. What is that? That is life insurance and disability insurance for the major players in your company, usually the owners. And why is that important? Because if an owner passes away, you need to make sure the company itself has the money to run if that owner was the rainmaker, or that company itself has the money to buy out that owner's estate and that owner's interest in the business. And that's really important to keep the business running and to pay the debts of the company. Okay. It's also really important for debts that you never knew about. I gave David this example. I had an unfortunate situation where it was a financial management company, 2 partners, and one of the partners unexpectedly passed. And it was also very unexpected that his girlfriend had a condo. He was married to a condo that was being paid for by the company, and the company had signed on to continue paying for the condo. That's a problem, because that is a true debt the business is responsible for. There was nothing illegitimate about it, and the business had to continue paying. So, you know, if you have partners, you'd always want to have additional coverage in case something should come awry and be surprising. Personal umbrella policy. So if, God forbid, somebody were to pierce the corporate veil to attack your personal assets, you want to make sure you have an umbrella policy of insurance. And depending on where you live and your personal background, they are relatively inexpensive to get several millions of dollars. Okay. And this will help you, unfortunately, defray the cost of many issues that could arise that would trigger that coverage. Even a car accident, if it goes above and beyond your auto insurance, can be assisted with an umbrella policy. So you may want to think about that. But again, insurance is only a safety net. It is not a hammock. And the first thing and the most important thing is to run your business correctly and accurately to ensure that you never have to implicate these safety nets.
Awesome. All right. We have 2 more slides. What about when things are going well and how to get money out of the business? But before we go there, there's some good questions. if you've made some of these mistakes in the past, and then I saddle up and start, flying right, how far back is somebody going to look? If I get in, I'm flying right now. Last year I did some of this silly stuff, and next year I get in trouble. Can the attorney look all the way back and say, well, 3 years ago you used your personal credit card to buy that computer, so tisk, we're gonna ignore the fact that you've been a good bird for 2 years.
So, David, we'll start with you. How far back does the IRS look?
Oh, I don't know. The IRS looks back.
The rule of thumb for the IRS is about 7 years. Getting into civil cases, things get weird. Why? Because we're looking at state laws. For personal injury in the state of New Jersey, it's 2 years. There are other states that are different. Contracts generally is 6 years. Okay, there's a 6 years of look back. And what does that mean? It means if I enter into a contract today, okay, somebody can sue me for my breach 6 years from now. So on one hand, I am not encouraging you to keep hiding mistakes that you made in the past. What I do encourage you to do is to fix them and fix them now, and talk to a professional if you need to. Talk to David, talk to me, talk to your accountant or somebody like us, and we'll help you not only fix it, but document it to show it as a fix as opposed to hiding, and make it right. Because when I'm litigating and I pierce the corporate veil and I see that something was fixed and it's obvious it was fixed, I'm going to look like a real jerk if I start hammering somebody who really tried to do well. And I'm in front of the jury just as much as you are. And I don't want to look like a jerk as an attorney. Although people try to make me look like one, it's super fun. But if it really looks like you tried to fix it, you tried to fix it. And that's more important than anything else. As a lawyer, I'd never say you would never get punished for trying to fix something. But trying to fix something is always better than trying to continue to hide it or ignore it. Because people can hide things, they just ignore them.
All right, so we got a couple of other good questions here. I'm an S Corp. If a shareholder has an LLC and takes money by 1099 from that LLC, does that pierce the veil? So let me break this apart. You are an owner of the S Corp. You're an owner of an LLC. You've filed as an S Corp. You should be taking wages, but instead of taking wages, you took distributions. And then your tax guy really screwed up when he said, I don't know what that money was that you took, but we're going to send you a 1099 for it. I mean, first of all, that's a huge mistake. But secondly, what would you say from a legal perspective, Lori?
Go talk to an accountant. Get that fixed. And it is, hopefully it only happened once, and it's obviously not right. I wouldn't see that as something that would pierce the corporate veil if it happened only once. It doesn't look like a reoccurring issue, and it's being documented, which is always not correctly, but you're not trying to hide it. So get that fixed. Go to the correct professional to make sure that that gets done well.
Very good. All right. My personal insurance person told me that my personal umbrella policy does not cover issues from my business, which you could understand, right? I've got umbrella insurance. I didn't buy it. I didn't tell them what business I'm in or anything else. It does interestingly cover me for my Airbnb business. If I have rental properties, it covers additional liability on the rental property, but I didn't have to introduce them to my company. So that's not really the question though, is it? The question is, if my corporate liability fails and subjects me personally to some liability, does the insurance cover me when other things? So
let's back up. Back up. Okay. So using the homeowners and using the umbrella, which is a form of homeowners insurance, when you get down to that, here's what has happened. Okay. They have determined that you don't have a business anymore. Okay. That you did not keep or maintain the business niceties, meaning you commingled funds, you didn't keep your corporate books correctly, and they have decided that you have acted in your personal capacity. So it's not where you're looking for umbrella coverage for your business. This is umbrella coverage for you because of what you did in your business. Okay, it's very different, and you want to make sure that that's very clear when you're talking to your brokers. So you're not looking, so I wouldn't be looking for, let's pretend I have a landscaping company. Okay, I'm not looking for the umbrella coverage to cover what my landscaping company did. I'm looking for the umbrella policy to cover me. Okay, should I have been driving my landscaping truck and got into a car accident and they decided that the LLC doesn't exist anymore. So really I was driving in my personal capacity. Okay, that's the difference. Now, it also could be that it still doesn't cover. I'm an attorney. It will not cover me. Okay, I have to have professional malpractice insurance. That's a full stop. So this is very much based on if you're a professional who is licensed and if you're not. So you need to talk to your broker. You need to explain why you want it, what your business is, and then get it. And again, this is like the fail safe. I am not advocating under any circumstances that you are relying on this 100%.
Good. Lily asks, if the company gets sued, can they go after our personal home since the owner of the company is only on the deed of the home? I think you understand that what she's saying is, I'm the sole owner of the business and I'm the sole owner of my house. I look the same. Does that automatically mean they can get my house?
No, and that's the whole purpose of having the business and maintaining these corporate steps so that they don't go after your house. As long as you maintain the business as a business and you don't commingle your funds and you run it like a business, then that's the whole point of it, is that they cannot go after your house.
There is one more slide I think is worth noting here, and that is, what about when things are going well? And particularly, you've got all of this cash from PPP and ERTC and EIDL in the bank. How do you get it out of the bank and into your personal funds? And I think there's 5 or 6 things to remember here. It won't be any surprise because you've seen this before. Clean books and a good paper trail is number 6. That's what I got to add to the conversation. But Lori, you've already been through most of these things, right?
That's right. Yeah.
You've got a lot of extra cash in the bank. Pay your bills first. Keep a capital cushion for the company. And by the way, academically speaking, you should have at least 2 months of all expenses. That means payroll and overhead and anything that your company spends for 2 months. That's the number that you should have of cash in the bank at any one time. And
Hey,
some
David,
people,
I have a question for you.
yeah.
2 months, even with what is going on with COVID and all that, you still say 2 months.
Well, that's right. And so, I used to laugh 2 months. Oh, like the world's going to stop spinning and nobody needs 2 months worth of cash. And then it did stop spinning and we really needed more like 6 months worth of cash. And so I would say that other folks say that that's anywhere from 2 to 6 months. But Lori, if you invited me in as a expert witness on a trial, I would say anybody who's got 2 months worth of cash in the bank for a small company, that's a lot. That's a milestone for somebody to put together that kind of a nest egg. And it ought to get them through most things, because within 2 months, you can make a lot of decisions as a small business owner to reduce your expenses, right? You go for a month of COVID time, 2022, you're going to fire people, you're going to lay them off, you're going to cut your payroll, you're going to, stop buying more inventory, all those things, so that you have probably a little more control over those things than maybe a bigger company. Timing is important. Just the last thing, this is something you and I talked a little bit about. If you want to take $50,000 or $100,000 out of your business, please be sure your business is otherwise healthy and that you're not facing a lawsuit. And so it looks like you're trying to hide that money, right? Or what other situations, Lori? You can't pull $100,000 out and then file for bankruptcy, I guess is the bottom line, right?
No, there's a 90-day look back on that. No, do not do that.
Okay, very good. So make sure you've paid everything for the business before you take money out, then do it on a regular schedule, document it in your board minutes, keep a paper trail, use a paper check to do it. When I had partners in the business, if I was going to take any cash out, I'd have a partner sign the paper check for my distribution and I would sign the check for his distribution. It was a really nice paper trail that said everybody knows what's going on here. So you can't have books that are too clean or a paper trail that's too clear. And as you said before, don't forget, juries are human. What would you believe if you were on the jury? So I feel like I'm cutting this short. There's tons more we could keep talking about, but we will continue to answer some questions here from the Q&A box as long as you want to hang out, Lori. And let's see, Paul, with an S Corp, is it okay to do lump sum distributions versus over time? I guess that gets back to this whole idea. We've got all this cash in the bank. How much can I take out right now?
So the idea of a lump sum distribution is weird for me. Okay. And the reason why I say that is because when and why are you taking it? So if you are, June rolls around, you're like, hey, lump sum, let's just do this. I don't know about that. But if you're going to bonus yourself at the end of the year or at the end of the quarter, along with bonusing your employees and making it fair, then that makes sense. Okay. Don't, try to do it at a regularly scheduled time when you would normally take money out of the business, as opposed to, making it a special event. I
Yeah.
think that's really important.
All right. And then the opposite of that question, Rick says, can I leave money in the business as long as it's earmarked as retained earnings?
Yes, you can, as long as the company doesn't owe you salary. Okay, so if you're leaving the money in the business and the business doesn't owe you any money and you're not going to claim that the business owes you any money, then it's fine to stay there. I mean, you could always, the more capital in a business is not a bad thing. Again, I'm not an accountant, so I'm sure they're going to have an issue with that. But if, as long as it is the business's money, it's not earmarked to go to a creditor, including yourself, it's fine to have capital in a business. Absolutely.
So I'm getting in a gray area here, but I want to buy a $200,000 piece of machinery 6 months from now. So I'm squirreling away as many nuts as I possibly can. At the same time, I'm not taking a salary because I want to get there as fast as I can. My salary on the balance sheet is accruing, and it looks like the company owes me $50,000, but I've got $150,000 in cash because I'm trying to buy that $200,000 machine. You're not suggesting that the company has to pay me before it buys the machine, right? Just so long as it's documented or earmarked for some particular purpose and what the strategy is and why we're doing this.
Right, and that's all reasonable.
Yeah,
that's that's what business owners do that all the time. That's what makes us business owners and not employees. Employees never have to do that sort of thing, but we as business owners do.
Yeah.
And documenting it, and then let's say for some reason the equipment is no longer necessary. You don't need it anymore.
Yeah.
Now you need to decide, how are you going to pay yourself what is owed to you?
Right. Lori Barb asked that, she said, we said the IRS can go back 7 years. How long after I close a business do I need to keep things, in particular, an employee document? Is there a different standard for employment law or harassment or anything dealing with employees?
So that's different in every state. And our rule of thumb is you simply keep everything for 7 years. You find the longest date and you keep everything for that amount of time. But I would check with an attorney in your individual state with regard to that, because the workers' comp issues are very different depending on how claims are opened and how they're closed and whether they stay open. So you should talk to a professional in your state. I can't give you a rule of thumb on that.
Yeah.
I'm sorry.
Okay. Thank you, Barb. Good question. I don't know the answer to that either. Carolyn asked, what if all of my assets are in a trust? Does the trust act as yet another entity with another liability shield in front of it? Lori, that's certainly not for me.
Whew. Yes, the answer is that's correct. As long as you are following what is required with the trust documents. And that is really in depth legally. And I don't actually practice in that area, but you really need to follow what the trust documents require on how you handle those investments, how you handle those properties. Because again, if you misstep, then all of a sudden, yes, they could go after what is in the trust. The whole purpose of the trust is that you follow it, and then no, people cannot attach those assets because technically they're not yours. They are in the trust owned by the trust and not you. So you really have to abide by those documents.
Okay. Will there be a recording and slides for this presentation? The answer is absolutely yes. You should get a email from Zoom with a link to the video. And if you send me an email at my email address, which I'll put one more time in the Q&A, david@diycfo.biz, email me for the slides and any other questions you have. Lori, thank you so much for sharing your expertise on all of this. Great stuff. Deeper topic than probably we've covered today, but really important for small businesses to understand and such a problem for so many people that I know who co-mingle. So thank you very much.
My pleasure. Have a great day.
Thank you.